Hello, and thank you for taking the time to join me on today's video. Today, we are going to go over my favorite topic in real estate in 2024, and that is loan assumptions. At the end of this video, you are going to be a miniature expert on how you can capitalize on assumable loans, both as a buyer and as a seller, if you happen to be in that position. We're going to cover a lot, so I'm putting timestamps on this video so you can go back and reference things if you need to. Drop a comment below if you have any questions. I'll try to keep an eye on this and answer them. And then, of course, you're welcome to call, text, or email me as well. So let's first get caught up to date on the challenges of today's market. There's a reason that I chose this page to start with right here. This is the last 50 or so years of interest rates in the United States. And unless you are a bit older than me, most of your life, you remember interest rates being below at 5% or under. But if we look back throughout history, starting back here in the 70s, going through when my parents bought a home in the early 80s, where things were in the high teens, you go all the way across this graph, and we don't even get into 5% until after the Great Recession. And it wasn't until the government started buying mortgage-backed securities around COVID that rates really shot down, which is pretty much what we're going to focus on in this video, specifically for buyers, is how you can get interest rates of yesteryear in today's market without having to do anything crazy like seller financing, although I think seller financing is an amazing tool. This, I would say, is a little bit safer and more predictable than seller financing. But perhaps we can talk about that in another video. For now, though, what is an assumption? What is an assumable loan? An assumable loan is a government-backed loan, FHA, VA, and USDA loans that have a clause in them that stipulates that the mortgage servicer must allow a qualifying buyer to qualify for, assume, and basically take over that loan from a willing seller. So things have basically shifted from a seller's market to a buyer's market ever since. If we zoom in on this graph here, if we go to the beginning of 2022, we can see that rates, we went just a little bit too far. We can see that rates started jumping up right at the beginning of 2022. So let's see, here we go. Here, 2021, end of 2021, we're still at 3%. 2022, boom, things almost double in the matter of a couple months. And it actually was a little bit slower, and perhaps we're going into too much detail here. This is historical home prices across a similar time span. You'll notice if we zoom in on COVID times, look how quickly things went up. Oh, and what do you know? When rates doubled, home prices started going down because, as we know, there's a correlation between your monthly payment and how much you can afford. So, the reason we are focusing on assumable loans in this video is because there's a way for you as a buyer to get an interest rate in the threes or even in the low fours. Somewhere in here is kind of the sweet spot. And the advantage to you as a seller, if you happen to be in this position, is if you have one of these loans, you can usually get a little bit more out of your home. So even if it's only $5,000, $10,000, maybe $20,000, what kind of a difference does that make to you and your family? As a seller, if you can sell your home for that kind of money, even if it's only $5,000, what is that? That's a pretty awesome family trip you can do. Or maybe that can go towards your kids' college funds, or maybe you can buy your kid a used car so they don't have to rely on you to drive them everywhere, right? But what if you're a buyer? The advantages become even more profound, as I'm going to graphically show you with numbers here. But first, before we go any further, we need to cover some foundational things. So, to keep matters simple, let's get familiar with this. The boring vanilla bank loan that everyone else is doing. Which, by the way, if you're doing this, there's absolutely nothing wrong with it. But let's dissect things here, because as you know, when you take out a mortgage loan, you are making monthly payments to a bank to eventually pay off your home. Typically, in this market, people are getting 30-year loans. There's a million different ways this can get done. For the average person, this is what they're doing. So let's start by looking here, and let's go slow. Pause, rewind, go back if you need to. But in this example, our home, the purchase price is $475,000. Let's say you want to do a 5%. Let's see, did I do 5%? I think I did 3.5% down payment. We do a I hope I can go back. Let me double check. I got to pause it here. Okay, I had to pause it, do some math on the fly. This is a 5% down payment, which is what you do when you are using a conventional loan. It's pretty much the lowest standard down payment you can make. There is an FHA loan, which you can do a 3.5% down payment. There's some disadvantages to that. This isn't necessarily the video to go into great detail on that. What we want to show right now is just the way a standard loan works when buying a home. So here we have all the cells. So look at this, 475 purchase price, 5% of that is $23,750. 475 minus your down payment is how much is left on your loan, which means you still have to pay the bank $451,250. Now, in this example, the interest rate was 7.31% at the time of this example, which is a real life example. That 7.31% paid out over 30 years means that your monthly principal and interest payment is $3,961. I'll expand on this in just a minute here, but the principal is what pays down this balance right here, 451,000. Your principal is paying that down. I'll show you in just a second, so hang tight with me. Your interest is the profit for the bank. Now, if you only put down 5%, or in fact, if you put down less than 20% down on a home, you have to pay mortgage insurance. And that is the bank's way of saying, hey, Mr. Borrower, you're not putting a lot of money down. You're kind of risky. We remember what happened in 2008 and many other times throughout history. And people don't always do what they say they're going to do. So if you miss your payments and we have to foreclose on you, that's a painful process for us, and we don't want to do that. If you're putting at least 20% down, we're pretty protected. But if you're only putting 5% down or 3.5% down, we're going to make you buy insurance for us to protect us from you defaulting on your loan. So that is mortgage insurance. It's called PMI, private mortgage insurance. Sometimes you'll see it as MIP, mortgage insurance premium, but that's what this $173 is right here. You also have property taxes that you pay on your home. In this home, it's about $219 a month. And then because this home is a townhome, townhomes often have insurance built into their HOA, their homeowners association fee, and that the homeowner's insurance on this is lower than it would be on a single family home. So you are paying $28 a month in this instance to protect your home. If this was a single family home, maybe that'd be $100 a month or something. And that's saying, hey, if your home catches on fire, the insurance company needs you to have insurance on that home. So that's to protect the home. The PMI is to protect them from you. But this cell right here is homeowners insurance. So this all four of these elements combined, or all four and a half, is called PITI, principal and interest, taxes and insurance, as well as mortgage insurance. This is what is known as your escrow payment on a mortgage statement. You see it in your escrow account. But this is the part that is important to the bank. So now that we've established that, let's look at how this affects things over the course of time. And I've hidden these cells so that we aren't inundated with too much data here. We're just going to stack things on top of each other as we learn here. And go ahead and ignore these for now. But again, there's the 5% down payment. If we were to do a 20% down payment, we would get rid of this mortgage insurance. And notice what happens to our payment. The more money we put down, the lower our payment goes. And that's because we have a smaller remaining balance here that the loan is based off of. But let's go back to 5% for just a moment here. All these numbers here are what is known as an amortization table. This goes for 30 years. This goes all the way down to 2024, or excuse me, 2054. And at the bottom here, we've created calculations to figure out the total amount paid over time. This is the principal column. This is the interest column. That's the bank's profit. And then this is just total principal and interest combined. Now, this is assuming minimum payments. You're not paying any extra each month, and that you hold the loan for the life of the original loan, that you're not refinancing. The reason that banks want you to refinance all the time is because, well, for one, they get a fee doing it, but two, let's look at this for a minute. Let's see, we don't need that cell. Okay, let's look at this for a minute. So remember how our payment was $3,500 a month? Of that, $3,100 right here, $3,096, is our principal and interest portion. So remember we said that's what the bank is concerned with. So each month we're paying that much money. So look, June 1st, we make our first payment. Of that $3,100, only $347 is paying down your balance. Look at that. 451 minus 347 is this number right here. And this happens each month. So if you'll notice, look at how much interest we are paying. When we have a 7.31% interest rate, we are paying mostly interest here. And this is why it's a really big deal that interest rates have gone back up basically to where their historical averages are. A couple months ago, the National Association of Realtors, which took a little bit of heat recently, did a study. The average interest rate over the last 50 years, 7.74%, which is pretty close to where we are right now. So as much as we like to think that rates are high, historically they're average. What's unfortunate is that when rates are low, home prices go up. So home prices have gone up for a very long time now, but they haven't gone back down that much. But interest rates have more than doubled. So that's what's created the environment we're in. As we scroll through this, you'll notice that each month our principal payment gets a little bit higher, our interest payment gets a little bit lower. So let's just scroll through. Here we are about halfway through the loan. look at how much more interest or how much more principal we are paying. Interest is starting to go down. By the very end of the loan, we're barely paying any interest, but we're paying a lot of principal. We're paying the loan off quickly, which means we owe less money. So, for example, if we were to sell the home, let's say we can sell the home for $500,000 and say we sold it at the 32nd month into the loan. Well, we would owe $439,000. So 500 minus 439, that's $61,000 there. Of course, we're simplifying. We're not factoring in commissions or anything like that. So that is what is known as your equity. Your sales price minus what you owe is your equity. So now that we've covered that, let me hit the pause button for a second here. Okay, so something else I wanted to show you is how, before we go into loan assumptions, I want to show you how big of a difference interest rates make. So this number right here is assuming we live in the same home for 30 years, we make the minimum payments, we don't refinance. There's reasons to not refinance, by the way. And we won't go into that in these videos, but we could if you ever want to talk about it. Obviously, I love nerding out. All right, so look at this. Over the life of 30 years, your total payments into this is $1.2 million for a $475,000 home. Pretty wild. Now, what happens if we give it a 3% rate like it was just a couple years ago? Holy crap. That changes things a lot. Look how big of a difference that makes. That is why we are talking about loan assumptions today. Also, look at what happened to these columns. Our principal is paying down we are paying down our principal significantly quicker, and we are giving the bank less interest. Also, remember how I said we showed that we're paying less and less interest each month? The bank loves when you refinance because it brings you back up to row one right here, which is where they are making the most amount of profit. If you get all the way down here, the bank is not making very much profit anymore on their loan. So they would love it if you got rid of that loan so they can get their money back and lend it out again and get right back up here. So let's move on. Let's actually talk about an example of a mortgage assumption because it helps to see things, to conceptualize it. Now you understand how a normal loan amortizes, how it pays off, how the bank makes their money. We're not factoring in any origination fees, which is like the starting process of a loan, because people got to eat, right? People who put that loan together, they got to get their fees, they got to get paid, they got to find a way to make their money. We're going to simplify, and we're not going to talk about what the lender is making here. But one of the best parts about assumable loans is that they're only for people that intend to live in the home. Owner, occupant only. No investors. Investors get so many opportunities to win. By the way, rewind, seller finance. Investors are killing it on seller finance. But this is your edge in the market right now. If investors could do this, they would buy all of them, but they can't. So here is your opportunity to be a savvy real estate investor, really, except this is going to be your personal residence for at least 1 year, maybe more, hopefully more. So, assumable loans. Let's expand upon this a little bit and open this up. So here we are, side by side, apples to apples. We can hide that column right there. We don't need that. We want to go apples to apples. We got two different things going on. This is the example of, what do we say, 7.31, I think. This is what everyone else is doing right here. This is a whole other loan side by side, so you can compare apples to apples. Remember how we broke this down? Principal, interest, taxes, and insurance. We're doing the same thing over here. But what we're saying in this example, and this isn't always the case, it depends on a number of factors, but in this example, we're saying, hey, the homeowner is able to sell their home for a little bit more because they are willing to offer a 4% FHA loan on this home, a rate that is no longer available. So even though this loan comes with PMI, or private mortgage insurance, even when you factor that in, the difference between these two payments is still significant. So let's pause this one more time. The difference between these payments is $675 a month. What would you do if you had an extra $675 a month? Furthermore, what would you do if even after the first 3 years, say rates don't change enough to matter in the next 3 years? By the way, go back and look at that graph. Or let's say rates go up. Just after 3 years, you would save almost $19,000. If you play it out over the course of 30 years, you'd save $240,000. And again, this is a conservative example here. There's a lot of opportunities out there that you can show even bigger savings, specifically with VA loans. And I'll show you why in a little bit. Why, if you're a veteran, we probably need to talk. But let's go back to this example here. So again, notice how much more principal you're paying than you are doing it the way everyone else is doing it. And again, you got to think of principal as money that is going towards an invisible bank account that you will see later in the future. So treat your future self. So in this example, again, the seller is getting a little bit of a premium here. $495,000 is the purchase price. You know, I ran comps on this home. I like to be conservative with my numbers. I think this home could safely sell for $475,000, but because they're making this offer, the purchase price, this offer to have an assumable loan, the purchase price is a little bit higher. And even with that, $675 times 12, you're saving $8,100 in the first year. When you add up the difference in the principal paydown, you're saving almost $13,000 in the first year. However, there is a caveat, just from a numbers perspective. There's some other caveats we'll talk about later, because nothing's perfect, right? This seller, still owes $459,000 on their loan as of June, or as of May. So basically, when this loan started at the beginning of 2022, remember right when rates started going up, right about there. So they got this 4% interest. They're already paid 2 years into the loan. When this buyer takes over the loan, they have to pay the difference to the seller in the amount of equity that they have in the home. So the first numeric caveat of assumable loans as a buyer is you typically have to put more money down. And that's why the sweet spot on these is loans that started in 2021. 2021 is the perfect time for these because home values haven't really gone up much since 2021. So there's a very small amount of equity that is cash that you need to bring to closing, but they still got that low rate. In 2020, home prices were cheaper, so there's a little bit more equity there. So if this home was purchased in 2020, it might look something like this, where you would have to come to the closing table with a little bit more money down. And I can show you some examples as to why it might be worth figuring out a way to source that money in the future. But for now, let's keep it simple and let's focus on this example. The last thing I want to show you with this is a graphical representation of what we're looking at here. This is the amortization shown graphically right here. Here we have the interest rate of yesteryear right here. Look at the legend. Principal is orange, interest is gray, and then the total payment of those two combined is blue. So that plus that equals that. So like we showed when we were scrolling down to the bottom, each month we are paying less and less interest, and we are paying more and more principal. Paying principal is good, interest bad. Right here, what is this, about 2035? So in about a decade, this happens where we start paying more principal than interest. Over here, it doesn't happen until 20 years in. Pretty wild stuff. So let's now that we're familiar with how this works, let's show some other examples. And again, there are some more caveats to doing this that we're going to get into. If you want, you can skip ahead to that in the video. But right now, let's show what a perfect deal looks like. And this is specific to VA buyers. If you are a VA buyer, either currently enrolled and have eligibility, or if you're a veteran, that's kind of the sweet spot. But either way, you're in a good position if you save some money and you have some decent credit. And here's why. Ignore this. In fact, let's do this. Hide. You don't need to see this stuff either. Hide. All right. Remember how we were saying that the bank needs insurance so that they can be protected against you in the event that you don't pay them back like you said you would? Well, when you do a VA loan, there's technically no mortgage insurance, but there's no such thing as a free lunch, right? The bank has to be protected somewhere in order to make this loan. So the VA has what is called a funding fee. There are exceptions where this is waived, where if you're service disabled, that's a one-off scenario that we can talk about if you ever want to. But for simplicity, most enrolled people and veterans have to pay a VA funding fee when they buy a home. So one of the major advantages of the VA loan is that you can get in a home for zero money down, or very little. There's usually some closing costs, but you can get in for zero money down. But for the bank to protect themselves, they're going to charge you a little bit extra. If it's your first home, it's typically about a 2.15% bump from the purchase price. If it's your second home, it's around 3.3. So what we have here is a home for sale for $528,000. However, the VA applies their funding fee of 2.15%, which increases your remaining balance to $539,352 in this example. So that is how the bank protects themselves, is they get this little bit of extra money here that basically acts more or less as mortgage insurance. And this is a conversation we can go into a lot more depth, but again, kind of unnecessary in this video. So here's someone doing a traditional VA loan right here. This is what 99% of people that are in the military or retired from the military are doing, I would say. But here comes the VA assumption. The reason VA assumptions are beautiful is because military members move every few years. So if you're a military member and you bought a home at the end of 2021 and you got to sell it now, you might not have any equity, partially because of this VA funding fee. And that's a really bad spot to be in. But if you have a huge benefit to offer, like a 2.5% interest rate, which is what some VA eligible people had, you have a massive opportunity to offer here. And that's why you can, if you have an agent who properly knows how to position this and how to advertise it, you can sell your home for more. But if you're a buyer, you're hoping that that listing agent knows just enough to know that their loan is assumable. You hope that they don't fully understand the power of it. And that's what we're going to show here. So in this instance, this was a home from 2021. Very little equity here, basically no equity. To buy this home, you would need a $39,000 down payment, which is about 7.5% down. And then here's our principal and interest. Same thing as before. I won't go into too much detail on this one because you can see how this stuff plays out over time. And you can see the graphs here. You can see that they're even more severe than they were before. You're paying more principal than interest right off the bat, which is crazy. And then look at how much of a difference this makes over the life of the loan here. This is over $500,000 difference between these two examples. Again, think if you're a buyer, how big of a difference could this make in your life? Yes, I realize I did not factor in a premium here for this costing a little bit extra. Typically, that'll be the case. Sometimes that's not always the case. It's ironically a case-by-case basis, and it's dependent upon the quality of the agents doing the deal. I will quickly give an example here of an agent, a listing agent who did do a good job of getting an offer for a home for over what is valued at. So in this instance, this home again was bought at either the end of 2021 or the beginning of 2022 when rates were still about 3%, and they basically have no equity in the home. In fact, you could argue that they have negative equity in the home. So this is a real life example. I have a buyer who had lovely woman, saved her money, very financially responsible, and she saved up a decent amount of money that she had to put down on a home. And she started learning about this stuff, and she knows that the VA assumption is the creme de la creme because there's no mortgage insurance, and they're incredible. And a qualifying civilian, basically a civilian with decent credit and decent income, decent consistent income that makes them bankable, can qualify to assume a VA loan. The caveat to that is that the seller who allows a civilian to do that loses that portion of their VA entitlement, which means they may not be able to use a VA loan to purchase their next home, which also means they may have to put more money down to buy their next home. Not everybody likes putting money down to buy a home. And that's why if you can put money down, even if it's money that is gifted from your family, you can get substantial benefit by having some money to put down here. So back to this example, my client had some money to put down for this home. She could have put close to $100,000 down if she wanted, but we saw that this home had a 2.875% interest rate available, a VA loan. My client was willing to offer over $40,000 above what this home would appraise for because of the massive benefits that she would be getting. This huge difference in price that she would get if she had to buy the traditional vanilla way. So even if she put 20% down to avoid her mortgage insurance, there's still a huge gap between the payments on a monthly basis, almost $600. So even though she's starting behind, she's very quickly making up ground. And by the 30th year, she'll save over $250,000. And she was willing to do this because she loved the home and she knew she would stay in it for a very long time. Now, unfortunately, in this instance, the seller, for reasons that are out of our control, is very important for them to retain their VA entitlement. But sellers don't always think that way. In fact, this same buyer, we got her under contract for a different VA assumption. But this is a long video. We won't go into that right now. But what I do want to talk about are some of the downsides to doing this, because you have to be in a unique position, both as a buyer and as a seller, to do this. And one of the major constrictions on doing this, aside from needing a healthy down payment, a lot of times, typically you can't get away with less than 5. Even if there's no equity, you still have to pay agents to do this for you. People that have this knowledge and the ability to bring stuff like this to the finish line, which, by the way, takes a bit more work to do than a traditional vanilla deal. They don't work for free. So the least amount you could ever get away with, I would say, is around 5%. And again, that's perfect scenario. Perfect. So as you can imagine, there are not a ton of these homes available. I didn't pull them up today, but in the entire state of Utah, there's around 70 or so of these available listed on the market. So yes, you can absolutely find a home that you will love. There are nice homes out there that fit this criteria, but you aren't going to get to pick every little detail on your home. And you're not going to get to pick the exact neighborhood you want to live in. You have to have a bit of flexibility. If you're looking in Davis County or Weber County, but especially Davis County, there's a lot of opportunities there. Salt Lake has some opportunities. Very few of them are on the east side of the city. Utah County has opportunity. Tooele. There's even some homes that are up into the $1 million+ range. Not many of them. So you have to have flexibility in terms of what you would buy, but also when you would buy. Because as you can imagine, if you are the bank, how motivated are you to quickly let someone assume a 2.875% rate when you could be lending it out at 7.13 or whatever it may be at the time of you watching this video? Chances are it's not 3%. So there's not a lot of urgency on their end, especially because they can't even really charge you. The maximum fee they can charge you is pretty low on this. It's a lot less than originating or starting a new loan. So these can take several months to do sometimes, and they don't make it easy for you. If you go do this the way that everybody else is doing right now, which again, I couldn't blame you for, and heck, I'd even help you do it if you want. But that lender who's helping you do it the way that everybody else is doing is highly incentivized to make that process as fast and easy for you as possible. If you do it this way, you're going to rely on me or your agent or yourself. Or if you do it with me, I have a lady who is a killer with this and knows how to. I'm not going to say she can definitely get these through quicker, although generally she can. What she can do is make it easier and safer. One of the most important things, one of the two most important things she does is before you even dip your toes in the water and make an offer, she can underwrite you. Depending on your financial situation, she can let you know if a specific deal we're looking at you would be able to qualify for. And she can let you know how close it might be. You want to have a safety margin here You don't want to, generally speaking, you don't want to be right on the edge of being able to qualify, because that puts you and the seller, for that matter, in a risky position. So she earns her value there, but also in organizing your paperwork to submit to the underwriter, to the mortgage servicing company who is qualifying you. So huge value there. But I'll leave that at that for now. I almost forgot that I wrote some of this stuff out to share with you guys. So as a buyer, you need to have decent credit. Again, it's hard to say exactly, but I'd say upper 600s is where you want to be. You need to have a little bit of money saved. This can come in the form of gift money from your family. And you need to have a very flexible timeline. These can take several months to close, 3, 4, sometimes even more. Typically not, but there's rare exceptions where it might take even more than 4 months. Yes, it's possible you could get lucky. It could take 2 or 3 months. Yes, I've had a scenario before where a buyer who is very safe in regards to her ability to qualify for one of these was savvy and negotiated a way where she could move into the home early. And it works out great for both parties, but that's not always the case. Also, again, like I said, no investors. And generally speaking, as a buyer, you can't already have a home and do this. There's rare scenarios where that's possible. If you're interested, let's talk. We can dive into details, but generally speaking, it's going to be best if you don't have any home debt on your book uh, uh, currently, especially if it's an FHA and or especially if you're going for an FHA loan in the same area that you currently own. As a seller, if you happen to have a minimal amount of equity, then you're in a good position. If you have 400 grand in equity, there's not many buyers that have $400 grand burning a hole in their pocket that are going to want to take advantage of this, or are able to take advantage of this. So you want to have a low amount of equity. You want to be flexible with your timeline generally. If you're trying to be a surgeon with your scalpel and have a perfect little, like, oh, I'm going to sell this and buy this at the exact same perfect time, that's really hard to pull off. I'm not saying it's impossible, but it's really hard to pull off. And it's got to be important for you to maximize your sales price, or sometimes just get your home sold. You might be in a position where after closing costs, realtor fees, and all that stuff, you might not have any money. In fact, some people are in positions where they would have to come to the closing table with money. And this is a tool that you can use here. So these are some things to consider depending on what side of the coin that you're on here. Let's see. I really didn't want this video to be this long, but hopefully you got something out of this. This is, I would say, months and months, but really this is a year's worth of experience in tracking the market in this department. Huge opportunities here. This is not something you want to just bulldoze through on your own, because there's a lot of pitfalls to watch out for. So if you have any questions about this, give me a call. I've got my number in the description below. Be glad to talk to you again. Drop some comments. I'll do my best to answer them. And if nothing else, thanks for taking the time to watch and listen. And I look forward to chatting with you.